Welcome to the 3 Edge Week in Review for the week of November 4th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will provide our initial commentary on the rather dramatic election results from this past week and the potential short-term and also longer-term impact that the election could have on the economy and the markets. In the immediate aftermath of the election, once it was clear that Donald Trump would be returning to the White House, markets responded. U.S. equities experienced their best post-election rally on record, with the Dow gaining more than 1,500 points as all three U.S. equity benchmarks climbed on Wednesday to reach fresh all-time highs. In addition, the U.S. dollar experienced its biggest gain since March of 2020. And meanwhile, over in the bond market, yields on U.S. Treasuries continue to climb higher. And as we know, higher bond yields equate to lower bond prices. Then, lastly this week, and somewhat overshadowed by this week's election, the Federal Open Market Committee of the Federal Reserve announced its unanimous decision to lower the Fed funds rate by 25 basis points to a target range of 4.5 to 4.75%. In the statement, which accompanied the FOMC's announcement on monetary policy, the Fed stated that labor market conditions have generally softened, but even though the unemployment rate has moved up, it remains low, and the risks to achieving both the Fed's employment and inflation goals are roughly in balance. So let me bring Steve into the conversation here. So Steve, Donald Trump will be returning to the White House in January 2025. And in addition, Republicans have also taken back control of the Senate and seem poised to keep their majority in the House. So certainly a strong showing by Republicans, to say the least. However, in hindsight, perhaps these results are not too surprising after all. It was reported in the Financial Times this past week that in the 10 major countries that have held national elections this year, in every one of those elections, the incumbent candidate or the incumbent parties in those countries with parliamentary systems lost. And in fact, this was the first time that this has happened in the over 120 years since these records have been kept by the research firm ParlGov. And the major reason given for the poor showing of incumbent candidates here in 2024 was voters' anger over resurgent inflation. Inflation seemed to be the straw that broke the camel's back for incumbent political candidates in 2024. So now the time has come for us to consider the potential implications of the election results on the economy and on the markets. And I'd like you to break down your analysis into first potential immediate short-term implications of the election, and then we will cover what the longer-term implications of a Trump administration could mean for the economy and the global capital markets in the years ahead. So let's begin by considering potential short-term implications of this week's past election results.
So we saw as you mentioned, a big market reaction as soon as it became clear that that Trump was going to take this election. And some of the biggest beneficiaries were not just U.S. stocks, but U.S. domestic-oriented stocks. And he's been very clear that he would like to improve the advantages toward U.S. domestic production. And so we saw a big gain there. And some of those stocks were actually laggards this year. Some of those stocks had underperformed. And so it's another opportunity, the extent that this bull market continues, for certain sections to play catch up with the overall averages. You also mentioned the U.S. dollar, and the U.S. dollar took an initial ride upward on the day following the election. And this was partly because long-term interest rates climbed very sharply. And all else being equal, this is helpful for the dollar because it makes the dollar a bit more attractive because you can earn a higher interest rate by investing in U.S. dollar assets. And then finally, Bitcoin soared to a new high. And this is primarily because Trump changed his position from several years ago, being against Bitcoin, to being highly in favor of Bitcoin. And the Bitcoin investors had taken notice of that. And so the idea is that the Trump administration will now be very favorable to the Bitcoin industry. Now, on the negative side, we saw the U.S. bond market get crushed right after the election. And when interest rates go up in U.S. bonds, principal value goes down. And along with that, mortgage rates went up. So we saw a real estate market get hit. We saw utilities get hit because those are very interest rate sensitive sectors. Following that initial plunge in the bond values, or that initial climb in bond yields, there was some give back after that initial climb. It remained to be seen how much higher bond yields might go. Some are thinking that bond yields are rising because the growth prospects are now better under the new incoming administration. Others say that yields are going up because there's a chance of the deficit growing even more quickly. So again, that remains to be seen. China and Europe stocks initially took a hit. And part of that is because Trump has made it very clear he would like to consider very strong tariffs. And certainly exporters out of Europe and China would not benefit from those tariffs. So there was an initial hit, although some reversal after that first day of hit. Then finally, commodities and gold took an initial hit because when the dollar climbed and U.S. bond yields climbed, that can be negative toward hard assets. But again, after that one-day jump in yields, there was a bit of a rebound in the bond prices and a bit of a setback in the yields. And then you saw commodities and gold reverse course. But those are the initial impacts.
Okay, so now let's look a bit further into the future and consider what might be the longer-term implications for global markets from this past week's election.
So I'm going to go through some opportunities and some positive scenarios, and then also some risks or negative scenarios that investors see longer term. One is the prospect of either extending the tax rates that we have now or even cutting them, whether it's on the corporate side or the personal side. And that certainly would be beneficial to corporations. Secondly, there's a lot of talk about deregulation and making it easier for companies to acquire other companies. And that is also seen as positive for corporations going forward. And that could all be good for the stock market. There's a fear that if a lot of the policies that were talked about during the campaign actually get enacted, then we could have continued rising government debt and deficits. Not all agree to that, but it is a risk. Next, we could have a return of the bond vigilantes. And this is in reference to the idea that if we do have rising deficits, if we do keep borrowing more money to either fund tax cuts or fund defense spending or fund other programs, then bond investors could demand higher yields like they have in past years, and in effect trying to add discipline to fiscal policy. Next, another risk is along the tariff proposals. We know from the past, the last time there was a tariff plan that was enacted that's similar to what Trump had been discussing was in 1930, the Smoot-Hawley Act. And a lot of people give credit for the Smoot-Hawley Act to have been a major cause of the Great Depression, because what happened was the U.S. government, in trying to do good for the country, raised tariffs to try to make it more advantageous for U.S. manufacturers and less advantageous for manufacturers in other countries. But that kicked off a tariff war in retaliation. That led to a trade war. And then that brought the entire global economy down. Remains to be seen if a similar scenario will unfold, or if the threat of tariffs is enough to get other countries to negotiate in a way that doesn't cause a negative impact. So that remains to be seen. Then finally, there's always a risk of stagflation. Could come from the idea that In the first year or two of an administration, often the incoming president decides this is the time to clean up economic issues. This is the time to take the hard medicine and maybe make sure we get inflation under control, make sure that we get spending down in corporate bureaucracy, et cetera. And there could be short-term pain for longer-term gain in the third and fourth year of an administration. So we could see a slowdown of the economy in the first year or two of the administration. And meanwhile, we could see rising inflation at the same time, especially if tariffs get enacted. And so we could be dealing with stagflation.
As always, my final question, based on the potential short-term and long-term implications of this past week's election, how might investors consider actually positioning their investment portfolios from here?
Well, if I could sum up a good way to think about investment prospects going forward, it's a term you and I have used before, and I think we should reintroduce it because I think it's very relevant. Radical uncertainty. There's so many different scenarios that could come true, both on the positive and the negative side, and not all generated in the U.S., but also with geopolitical risk going on in the world, that we think it's an especially important time to be highly diversified. So we are happy on behalf of our clients to have hedges that deal with a lot of the negative scenarios. Gold would do a great job dealing with stagflation, dealing with geopolitical uncertainty, dealing with runaway deficits. TIPS would do a great job if inflation were to rebound in a way that people don't expect. Having some short-term treasuries is smart in case the markets end the rally and form a correction. That's dry powder that one can use to buy stocks at a future bargain and then have a much better prospect of returns following that correction. Having exposure not just to U.S. stocks, but internationally can help add to diversification. Now, on the positive side, we do believe that to take advantage and to be positioned for some positive scenarios that we could imagine, we think it's very important to have an allocation to equities. Maybe not 100% allocation and be at full risk, but to have a healthy, diversified allocation to equities. And in the U.S., a mix of equities that are have done well and continue to do well in the market, but also to consider certain equity indices that perhaps have underperformed or at relatively much better valuations, and where investors might look to put money where they find that some of the sectors that have performed the best are already highly overvalued, like we believe. Also, with international markets, one has to be a bit careful because some of those international markets are targets of a tariff policy. On the other hand, a lot of those international markets have already come way down in valuation, anticipating trouble. So if we don't get the kind of trouble that people fear, those could be big bargains as well. So if there was ever a time to be highly diversified, both for upside scenario and downside scenario, now would be that time.
Thanks, Steve. I think this certainly could get interesting in a hurry here. And I think bringing back our expression of radical uncertainty to describe where things stand with the economy and the market is appropriate. And perhaps most important, it does certainly seem as though this could be a good time for investors to be well diversified. So that will do it for Steve and me for this week. Eric Beagleisen and I will be back next week with our monthly 3-Edge View from the Edge, where we will provide our most recent outlook for the global capital markets, and it'll be interesting to see how our model research may interpret the recent election and its effect on the markets and the economy for the remainder of 2024 and beyond. As a reminder, all our videos are always available on our 3Edge YouTube channel, and if you know someone who might enjoy and benefit from our weekly videos, please feel free to share them. In addition, if you enjoy watching the videos and find them to be helpful, please consider subscribing to our 3Edge YouTube channel. We would be most appreciative. So, until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.